Financing is the backbone of real estate investment, allowing individuals and businesses to leverage limited capital to purchase high-value properties. In the UK, property investment is highly attractive due to the strong demand for housing, steady appreciation in property values, and potential for rental income. However, understanding financing mechanisms is essential to navigate the complexities of the market and make profitable investments. The UK real estate landscape offers opportunities ranging from residential buy-to-let properties in cities like Manchester and Birmingham to commercial investments in office spaces and retail outlets. Financing options vary depending on the type of investment, the investor's financial profile, and market conditions, making it crucial to align financing choices with investment goals. Types of real estate financing. 1. Buy-to-let mortgages. Buy-to-let mortgages are the most popular financing option for investors purchasing residential properties to rent out. These loans differ from standard residential mortgages as lenders focus on rental income rather than personal income. 1. Typical requirements. A deposit of 25%-40% of the property's value. Rental income to cover 125%-145% of mortgage payments. Strong credit history and financial stability. Example: purchasing a £250,000 property with a 25% deposit, £62,500, would require a loan of £187,500. If rental income is £12,000 annually, it must meet lender thresholds for approval. 2. Bridging loans. Bridging loans are short-term funding solutions for investors who need quick capital, often for auction properties or refurbishment projects. 1. Features: higher interest rates, e.g., 0.5%, 1.5% per month. Short repayment terms, typically 6-12 months. An investor purchasing a £200,000 property at auction might use a £150,000 bridging loan to secure the property quickly, then refinance with a traditional mortgage after renovation. 3. Remortgaging for equity release. Equity release involves refinancing an existing property to access its increased value for further investments. If a property purchased for £200,000 is now worth £300,000, remortgaging at 75% LTV could release £225,000, allowing £25,000 to be withdrawn after repaying the original mortgage. 4. Joint ventures, JVs. Joint ventures allow investors to combine resources, with one partner providing capital and the other managing operations. This strategy is effective for high-value projects where individual resources are insufficient. Example: Partner A contributes a £50,000 deposit, while Partner B secures financing for the remaining £200,000 property value. Rental income is shared based on the agreement. 5. Crowdfunding platforms. Platforms like Property Partner or Crowd Property let multiple investors pool funds for property investments. Advantages: low entry costs and diversified risk. Drawbacks: limited control and shared returns. 6. Commercial property financing. Commercial loans cater to investments in office spaces, retail outlets, and industrial properties. These loans often have longer terms and higher interest rates but yield higher returns through longer leases. Key financial concepts and metrics. 1. Loan-to-value ratio, LTV. LTV measures the proportion of the property's value financed through debt. Example: a £300,000 property with a £75,000 deposit has a 75% LTV. Lower LTVs reduce lender risk and offer better rates. 2. Rental yield. Rental yield measures profitability by comparing rental income to the property price. A £200,000 property generating £10,000 annual rent has a 5% yield. 3. Debt-to-income ratio, DTI. DTI assesses whether an investor can handle additional debt. Threshold. Lenders in the UK often require DTI ratios below 43%. 4. Cash flow. Cash flow is the monthly rental income after deducting expenses like mortgage payments, maintenance, and taxes. Positive cash flow ensures long-term financial stability. 5. Capitalization rate, cap rate. Cap rate evaluates return on investment for a property. Costs and taxes in UK real estate investment. 1. Stamp duty land tax, SDLT. Investors pay SDLT on property purchases above certain thresholds, with a 3% surcharge for additional properties. 1. Example. A £300,000 buy-to-let property incurs £14,000 SDLT, including the surcharge. 2. Income tax. Rental income is taxed at standard income tax rates, though deductions for expenses can reduce taxable income. 3. Capital gains tax, CGT. CGT applies to profits from selling investment properties, with rates of 18%–28% depending on income levels. 4. Maintenance costs. Regular maintenance and unexpected repairs must be factored into financial planning. How to prepare for financing. Build a strong credit profile. Lenders prioritize applicants with high credit scores. Save for deposits. A 25%–40% deposit is standard for buy-to-let mortgages. Organize financial documents. Proof of income, rental income projections, and property valuations are essential. Current trends and challenges. Interest rates. Bank of England rate hikes have increased mortgage costs, squeezing profitability. Regional variations. Northern cities like Manchester and Liverpool offer higher yields than London. Alternative financing. Private lenders and crowdfunding are filling gaps left by traditional banks. Strategies for maximizing returns. Target high-yield areas. Focus on regions with strong rental demand and lower purchase prices. Diversify investments. Spread risk by investing in different property types and locations. Leverage refinancing. Use equity from appreciating properties to fund new investments. Financing real estate investment in the UK is a multifaceted process that requires careful planning, knowledge of market conditions, and a strategic approach to leveraging financial products. By understanding options like buy-to-let mortgages, bridging loans, and remortgaging, alongside key metrics such as LTV and rental yield, investors can build profitable portfolios while navigating costs like SDLT and interest rate fluctuations. Success lies in preparation, diversification, and staying informed about market trends.